And good morning to Ajay Srivastava. Ajay, good morning. Thank you for joining us. Was last Friday a reality check or yesterday, which is Monday, an indication of what lies ahead?
I would say both. The reality check was the good point that there will be volatility in the market at this level, so investors need to learn to live with the volatility. And yesterday's lesson was that when you sell off, you don't short this market. That's the bottom line. You may sell and book profit, which is fine with me. Money in the bank is worth a lot, but shorting this market is treacherous at the best of times, and certainly not where the market is located. Surely, things will keep changing. That's the nature of the market. But I think the paradigm is do not short the market at this point of time. And that's been true for the last 5 years. Shorts have not made money. So lesson is no shorts, profit booking all right, but shorts is a dangerous game to play.
It's such a great point that sell the market but don't short the market. I just want to bring this out for our viewers. What Ajay is saying, that just because markets have fallen down, you don't go out and create naked short positions because you think market prices are higher. Trend is your friend. And I'm saying this again and again to our viewers because on my social media account, when I speak to my friends, when I look around, people just ask me, okay, we missed the market rally on the upside. Should we sell the market because markets are poised to go lower? Trust me, it does not work this way. Ajay, one sector or one space where there is definitely a reason of re-rating is PSUs. Whether it is the play on the economy or government's investment, government's commitment towards strategic stake sale. How would you approach the PSU space? Would you align with companies where a strategic stake sale is coming, or would you align with other PSUs which may not be sold but have a lot of value?
Okay. First of all, I must share that this comes with experience of holding PSUs for a long time, which didn't make money for anybody. So they have been the worst possible, stocks to hold in the last 5 to 7 years. That's for all to see. Now the question is, do they get re-rated now in a significant manner, given the low valuations compared to everything? All PSUs are basically around 1 to 1.2 times or maybe lower than book value. So to that extent, you are on a safe ground to buy it. The question is, will the sell process come through completely? Is that going to happen? And will the situation or change of management at most PSUs again be done? Lots of promises, lots of things have happened over the years, but nothing materialized in true privatization sense. So the trust is, I think positioning wise, you can buy some of the stocks. They're expensive, so I would kind of be careful of buying it. Nalco was 25, it's now 60 rupees. So was, SAIL, and so is other stocks. All the petroleum companies, marketing companies, you've seen what's happened to them. They all got re-rated significantly. Holding, I think you're holding them. It's wise to keep holding them. There are newer stories coming. You saw Railtel coming at a dirt cheap valuation. I don't know who values these companies. At 3,000 crore, they did an IPO. That merchant banker should be shot dead, really speaking, should be banned from the market. He doesn't understand what the assets are, valuing a company at 3,000 crore. So you will get some nugget. You saw what happened in IRCTC as well. So there is enough money to be made, but be careful that this is one sector which has hurt investors the most in terms of return, rewarded the most in terms of dividend. So whichever way you play, I think March you'll play for dividends and privatization. But longer term, I'm not a great holder. If privatization does not come through, I would sell most of my PSU stocks at in a whiff at this point of time. So hold for dividends, hold for privatization, but sell if you think that is going to be a repeat of what last 5-6 years have been all about.
Fair point. Two-wheelers are now getting, or the entire auto space is getting divided. The auto dispatch numbers for two-wheelers, Ajay, they are plateauing out with a downward bias. For four-wheelers, the slope also seems to be reducing. But for CVs, the slope is almost like a V-shaped recovery. How would you position yourself in the auto space?
See, autos, I think two-wheelers, you should not pay attention to month-to-month dispatches, because the longer term trajectory of all these stocks is of two things. Good part, strong equity in this company, almost zero debt in most of the companies. Highly rewarding to shareholders is the third aspect. Whether Hero does more the reward to the shareholder than Bajaj does, for instance. So in a sense, you need to buy these for a little longer term, Nikun. Then don't worry about month to month. These stocks reward you a lot. There is a lot of franchise value sitting there. And yes, you can never expect that the turnover will keep going up as petrol prices keep rising, the discretionary income is going to fall, and therefore less people are going to buy goods and products. All will trade down. And that's where the advantage of people like Hero comes in. They are at the bottom end of the cycle of the product range of the two-wheeler, so they really reap the benefit of anything. I would say these are wonderful long-term buys in a country as like India is, with road infrastructure going up. Do not pay attention to this one. Pay attention to the rewards that comes with it, the dividend stream which comes with it, the buyback which comes with it. That's what you got to look at it. Longer term, don't forget about, worry about it. And month-to-month trends, it's really in March, for instance, they will push volume. You'll see a substantial growth in March volumes. But that's par for the course. 1 month good, 1 month bad. I think it's okay. But March will see volume bust will go up dramatically for the year-end closing.
Right. I'm just scanning through the entire market breadth, and the market breadth is not powerful, but it is stable. When I say it is not powerful, you don't have like big spikes in individual stocks today, but you don't have too many stocks which are trading with a negative bias. So stability is what we are looking for. You don't want to see market go up 500 points, then you feel happy, and the next day you see markets are down 500 points. That's volatility. That will chop off the traders. But when you see 10, 15 days, even 3 weeks of sideways consolidation in a tight band, that's very healthy. And for a change, that's what at least the FNO screen is telling me. IRTC, it's a stock which in a sense has been trending up very, very smartly. Now that stock is in FNO space also, could be interesting. Ajay, let's work with an assumption that this year will be a better year for us on the health front. The vaccine rollout has happened. We know that vaccine rollout has moved to the second stage, which means that in next 6 months, a lot of Indians would be vaccinated. So this entire fear of travel, holiday, leisure is going to come back. Is there merit in buying, let's say, a travel company, a tourism company, a hotel company, with the assumption that the pent-up demand would unleash itself in the next 3 to 6 to 9 months?
Okay, here it is. Long-term theory and hotel industry worldwide has been the poorest reward to the investor. They don't give returns to investors for whatever reason. Asset intensity is high, the cost is very high, and so you will have small burst of time when they become mispriced as an asset, and you can make money. And I think that's an opportunity today. You will see the fact, 2 reasons for India, not only that leisure travel, but I think the postponed marriage season which is going to come around. India has a very large market driven by marriages. And that is what is going to make big money for the hotel in the next, and all allied industries, I must say so, in the next 12 months. It's going to be a huge amount of money to be made. But the key is get out after the next year results are out, because then you've written this thing. It's a wonderful play today, hotels. You rightly said it's a beautiful play today. They will make tons of money. New capacity is almost zero coming up in the market. If marriage season kicks in, it's going to be huge, huge upside for the hotel stock. Absolutely wonderful play, but it's a 1-year play. It's not a 5-year. It's not what you plan to do your retirement fund with. It's not what you plan to do with children's education is. It's a plan that you say, I'm going in here with a clear discipline that come 12 months, 15 months, I will exit this stock. If you do that, that's wonderful. Nikul, the second point, I just want to bring in nothing to do with stocks. But today, the discussion paper of SEBI, which has come up with independent directors, I think that's landmark. If that is adopted, the whole mid-cap space, becomes really fantastic for investors to go in, because the governance overhang will try to at least come down on it. And I think if they can implement this, it's going to be a landmark change for the way Indian companies are governed. And you will find a lot more comfort with B and C category companies than all of us have today. And we have seen the mishap. Not only B, C, even A category, let's say Vedanta. How did the independent board give a loan to the parent company? That's bizarre. And there's still directors on the board. Under the new guidelines, those very directors would be removed from the board, and a clean set of directors, independent directors, would come on a board like a company like Vedanta. I think today's discussion paper is a landmark for capital market. If it gets adopted, the big buying will happen in mid-cap stocks without the governance overhang. I think that's important to understand, that more than economic fundamentals is the governance fundamentals and problems which plague 90% of Indian market.
Fair point there. Ajay, what about metals, building stocks, ancillary plays there? Metals, of course, is a story in itself on the back of what's happening globally and on commodity prices. But, in terms of really fitting in with the cyclical theme and how that's playing out, is this a segment that you're also looking at fairly optimistically?
Almost 30% of our holdings our is in those segments, and I have only one word: buy, buy, and buy. These cycles last for years, maybe even a decade. The cycles will last. There's not okay. You may have corrections. Sure, you'll have corrections. I'm not saying it's going to be a one-way street, but these cycles come in 10 years and then they go after, and then you get off the track for 10 years. So if I think they've just started at this point of time, if India says we want to grow at 7%, 8%, or whatever the number is, the kind of requirement of materials is going to be humongous, absolutely. And therefore, and all these companies in this space, metal companies, by and large have addressed the debt problem at the operating level. So it's a clear case of buy. So whether it is metal companies, ferrous, non-ferrous, both, whether it is your building product company, which is tiles, paints, etc. And you saw, of course, now Grasim wants to get into paint because it's a highly profitable business. I think it's a great thing. And number three, most important, the big players in real estate have now come into the country and they are under RERA, etc., has made a difference. So now it's a more organized market, less bad debts will come into place, more purchasing will happen. And therefore, what you are seeing is perhaps, I think the first 10, 15% of re-rating has happened. The balance 75 to 80% re-rating is still to come over a period of time. You got to be patient, but that's a way to be. Park your money and be there. And last point, beautiful dividend, absolutely wonderful dividends coming from these companies, because the parents of some of the companies like Vedanta need the money. So not only and Hindustan Zinc, for instance, etc., and of course, obviously steel companies. So you will enjoy lots of free cash flows, lots of dividend, none of them doing large capex, and the money is just started to flow in. It's been first 12 months where they've seen the free cash flows becoming positive. So I think the long cycle, be patient, and the only answer is buy, do not sell these sectors.
Fantastic. Ajay, is there any indication you can give me in terms of the kind of names that you're looking at within some of these pockets, whether it be, real estate or the ancillary plays, that you've just also talked about, metals, of course, but even in terms of the broader markets, anything that you're quite bullish on?
See, India has become a land of stories. Like, who would have thought that I would have made a buy in a fashion wear company? Last month we started buying a fashion wear. Who would have thought, for instance, that there is a tremendous re-rating taking place out there? Metal is old hog. I don't think if I tell you to buy, Vedanta now is looking expensive in the short term, etc., etc. So it'll be, it's an old story. You wait for correction and so on. But the newer stories are coming out every day. The new listings are coming out. You saw the QIPs happening in things like India Mart, where we hold shares at the point of time. You're seeing Affle is about to come in. So the new gig economy, that's where you got to focus. Whether it is newer IPOs or the older companies in the new gig economy, that's where you got to focus. Companies who are pivoting, companies who are on the sector. I think you need to go whole hog there. And India is underinvested in the sector by and large. We don't have too many IT companies. We don't have a Netflix. We don't have anything, even Roku or anything of that kind. So I think the focus should now be, forget the old economy stocks. They will do okay. Cement, yeah, it's so good for institutions. I'm not a great buyer. Go for the new gig economy because you're going to make money there. Because these are entrepreneurs who are willing to raise capital, no debt, and do what? M&As, sell their companies. So now this year, there'll be number of IPOs. Whatever is there, if you're not in intermediation companies, you better be there in the company. Allocate a capital and say, 33% I will devote to new gig economy companies and full stop. That's what I want to do. And stick to that plan. And a lot of them are very unknown. So none of you talk about it. In most of the channels I see, it's very limited visibility for most of these companies, which is quite strange because they are the big value creators. But I think new gig economy stocks is where you got to focus, where we are focused upon. Metal story, we've got enough on our plate. We don't want to buy more at this point of time. Odd stories do keep coming. As I said, who would have thought I would have bought a fashion wear company?
Please enlighten us, Ajay. We are all ears. We also want to hear about these new gig economy, unheard of names.
See, okay, unheard is the wrong word because when I meet people, none of them know about this company. When you want into India Mart, which we are holding for a long time now, nobody's heard of this company. The guy is not on the front pages. He's not there, but he just raised this QIP at 8,600, but still largely ignored in the market. Then you have all other, you saw what happened to Onmobile, went to 26 rupees or 30 rupees a share. Disaster, absolutely. He was a pioneer in the mobile phone products at the end of the country. and they've got good profitable company going up begging, and now it's gone up to 100 rupees or so, but that's where it is. You've seen Affle, which has got strong AI capabilities in telephone, in the mobile phone industry, that's gone up begging. You saw what happened to Just Dial. It was the only profitable new gig company, and it's unbelievable. His valuation was 2,500 crores. You know what I mean? It's ridiculous, absolutely, given what he had on assets on the ground. It's gone up a little bit, but I'm not saying buy any of these stocks. But since you asked quoting, all these stocks were there for a given, absolutely. But as I said, we focus too much on the old economy. Economy is changing, the world is changing. Let us give credence to the new economy. Take your money and park it there. You know, the way government policy and economy are, 1/3 of the companies, we believe, listed companies in India, will be absolutely gone in next 5 years. Now that's a large number. We can share the list with you. We have got a list made internally. 33% of companies will be bankrupt and delisted, or may not be delisted in the next 5 years from BSC. And that's a lot of companies. That's about 800 companies. So you need to be clear that are you part of those companies? Get out of them. Get into the new companies, healthcare companies, IT companies. It's a new world out there. It's so exciting. I can't believe it. I don't want to be old. You know what I mean? I want to restart my life now.
Okay. Also, I just wanted to understand, there is a very aggressive home loan rate war out there. I mean, as of yesterday, Kotak Mahindra Bank, although for a limited window up until only March 31st, had reduced their home loan rates to 6.65%. You've got an SBI at 6.70, HDFC Bank at 6.8, and ICICI Bank as well at 6.8. How is it that you're reading into this competitive aggression which is playing out there? Because a large part of the segment wherein you are seeing, buying kick in is the affordable segment. So in that sense, the ticket sizes of these home loans is much lower than what would be perhaps pre-COVID.
It's an indicator, that there is nowhere to lend. And I think that's what's happening in this country. Most companies are now able to access capital, and they realize that when capital available at these valuations, why the hell borrow money? Let's dilute. So you see across the board QIPs, PE fundraising, sale of companies, whatever. I don't meet a promoter who wants to borrow money at the end of the day. He said, listen, why am I borrowing money? Let me raise capital and I'll keep it in the bank. So I think one is the sheer desperation of not having enough avenues to lend money to. How much can you lend money on your personal loan, unsecured loans, etc.? That's not the smartest way to play the game. Historically, real estate loans, housing loans have been the most stable platform for most of the institutions. HDFC ran the roost, will continue to run the roost because the DNA is very different of HDFC. The cost structure is very different. Now, these banks will often come in, play the game, and try to get you as a customer. But all it tells you is changed. There are no borrowers of significant kind, and they have run through individuals as a borrowers, because who wanted to borrow, you don't want to lend to, and who does not want to borrow is what you're targeting. So it's a very peculiar. So I think as a banks, you will see more and more of this happening because sheer demand of loans is collapsed in the economy, and that's the challenge the economy has. That's a challenge the banks hold. So it's symptomatic of the lack of avenues of lend, not just being philanthropic about it or being nice to us and says, I'm going to give you. And, headlines, look at the headline, 10 basis point reduction. And a newspaper said, house loans slashed. What is it, 10 basis points? It's not even getting your petrol of 1 liter of petrol at the end of your monthly EMI, for God's sake. So yes, it's down there, but not so much that we get excited.
Would you buy HDFC Limited in your portfolio, Ajay? Given that if India comes back, home loan, the desire to buy housing, that's not going to go away. I mean, it's such a fantastic business, but the stock is underperforming.
It's okay. I don't think it's underperforming. I think what's happened to the stock is it got re-rated quite sharply. If I'm not wrong, it went from, I have a holding in that stock and I continue to hold. Okay, I don't sell that stock. From 1,500, it went to 2,800, got back to 2,500. If I'm not wrong, that's a rough trajectory of the stock, right? But it's a franchise which is absolutely mind-blowing, incredible franchise. And I think they have done a remarkable job at doing two things: balancing corporate real estate loans and individual real estate loans, doing side investment as well, And of course, holding company at that point of time, they hold the best bank in the country, they hold the best life insurance company, the best AMC in the country. Now, if you got to play India story, you can't, that is the India story at the end of the day. What they don't have, I agree with you, they don't have fintech in their portfolio. To that extent, they got a problem on the one leg of the entry, but maybe through HDFC Bank, they will come in. But there is no better surrogate for Indian economy, if you ask me, than a HDFC as an institution. It gives you exposure to everything. So it's one, and it's safe. Governance-wise, it's safe. So no reason for it to be sold ever. Keep buying. The problem with them is that it is so overowned as a stock that if FIs decide to sell or one large FI decides to dispose of, you will see a large correction in the stock. That's a big problem with that stock. It's overowned by everybody, including FIs. But as a retail person, if you're starting your life investing, I would say that's the stock, as I mentioned, I want to keep for my children's education. That's the stock I want for my retirement. So it's in a separate category. Don't evaluate it day to day. Say that 17 years from now, this stock should pay for my son's education. It will pay for it.
Well, appreciate your time. Thank you for joining us.
Thank you.